Sir, please start.
Okay, thank you. So, good afternoon to all of you students. And today in the financial management, I'm going to take cash flow statement. So, it is a very important topic, and you have to learn this cash flow statement well so that you can explore in the examination hall. Now, as simple as if we consider three words cash flow statement. So, cash means is a hard cash, flow means inflow and outflow, and statement means which is not an account. Now, a simple definition of a cash flow statement is a statement which discloses the changes in cash position between the two periods. So obviously, when we are going to prepare the cash flow statement, definitely we'll be having two periods balance sheet. And with the additional information, we are required to prepare the cash flow statement. Now, along with changes in the cash position, the cash flow statement also outlines the reasons for such inflows or outflows of cash, which in turn helps to analyze the functioning of a business. So, the idea behind cash flow statement is that it is going to pinpoint the reasons for cash inflows or outflows, and by the by, the functioning of a business that is going to depicted by the cash flow statement. Now, definitely there are certain utility, importance and objectives of the cash flow analysis. The cash flow statement is an important planning tool in the hands of management. And a cash flow statement is useful for short-term planning. Now, a business enterprise needs sufficient cash to meet its various obligations in the near future, such as payment for purchase of fixed assets, payment of debts maturing in the near future, expenses of the business, etc. Now, a historical analysis of the different sources and applications of cash will enable the management to make reliable cash flow projections for the immediate future. It may then plan out for investment of surplus or meeting the deficit, if any. Now, I'm just going to discuss the chief advantages of the cash flows. Number one, helps in efficient cash management. That is, it helps to determine how much cash will be available at a particular point of time to meet obligations like payment to trade creditors, repayment of cash loans, dividends, etc. This helps to provide information about the liquidity and solvency information of an enterprise. Point number two, helps in internal financial management. A proper planning of the cash resources will enable the management to make available sufficient cash whenever needed and invest surplus cash, if any, in productive and profitable opportunities. Third point is cash flow statement discloses the movements of cash. It helps in understanding and analysis of what are the sources and application of the cash for a company. Also, it discloses the volume as well as the speed at which the cash flows in the different segments of the business, thereby helping to analyze the different segments of the business. Next, historical versus future estimates. Historical cash flow information is often used as an indicator of the amount, timing, and certainty of future cash flows. Point number 5 discloses the success or failure of cash planning. It helps in determining how efficiently the cash is being managed by the management of the business. Now, next point is comparison between two enterprises. Cash flow information is useful in assessing the ability of the enterprise to generate cash and cash equivalents and enables users to develop models to assess and compare the present value of the future cash flows of different enterprises. It enhances the comparability of the reporting of operating performance by different enterprises because it eliminates the effects of using different accounting treatments for the same transactions and events. Point number 7 is analysis of profitability vis-a-vis net cash flow. It is also useful in examining the relationship between profitability and net cash flow. Now, ASC devised an Indian Accounting Standard 7 has defined the following terms as follows. Number 1, cash comprises cash on hand and demand deposits with bank. Number B, cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. Then number C, cash flows are inflows and outflows of cash and cash equivalents. Operating activities are the principal revenue producing activities of the enterprise and other activities that are not investing or financing activities. We will come to these points later on also. Then investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Next, financing activities are activities that result in changes in the size and composition of the owner's capital, including preferential capital in the case of a company and borrowings of the enterprise. So, these are the terms that you have to understand well. Then we are coming to discuss cash and cash equivalents. Cash equivalents are held for the purpose of meeting short-term cash commitments rather than for investment or other purposes. For an investment to qualify as a cash equivalent, it must be readily convertible to a known amount of cash and be subject to an insignificant risk of changes in value. Therefore, an investment normally qualifies. I have written this as a cash equivalent only when it has a short maturity of, say, 3 months or less from the date of acquisition. Investment in shares are excluded from cash equivalents unless they are in substance cash equivalents. For example, preference shares of a company acquired shortly before their specified redemption date, provided there is only an insignificant risk of failure of the company to repay the amount at maturity. So that is all about your cash and cash equivalents. Now we are coming into detail and we are discussing about presentation of cash flow statement. The cash flow statement should report cash flows during the period classified into three important categories. And the first category is operating activities. Second category is investing activities. And the third category is financing activities. Now, classification by activity provides information that allows users to assess the impact of those activities on the financial position of the enterprise and the amount of its cash and cash equivalents. These information may also be used to evaluate the relationships among those activities. So, remember, classification by activity into operating, investing, and financing provides information that allows users to assess the impact of those activities on the financial position of the enterprise and the amount of its cash and cash equivalents. And this information may also be used to evaluate relationships among the activities like operating, investing, and financing. Now, a single transaction may include mix of cash flows that are classified differently. For example, the installment paid in respect of a fixed asset acquired on deferred payment basis, that is, payment to be made after certain period at a future date, includes both interest and loan. So mind this example. The installment paid in respect of a fixed asset acquired on deferred payment basis includes both interest and the loan amount. The interest element is classified under financing activities, and the loan element is essentially is classified under investing activities. So mind this is very important. Now we are going to discuss about operating activities in detail, because when you'll be provided a question on cash flow, you are required to classify the various information that will be given in the question paper into operating, investing and financing activities, and you are required to compute whether there is generation of cash or there is cash is used. There is no generation. So operating activities we are going to discuss right now. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the enterprise. Therefore, they generally result from the transactions and other events that enter into the determination of net profit or loss. Now, the examples of cash flow from operating activities we may list. That is, number one, cash receipts from the sale of goods and the rendering of services. Number two, cash receipts from royalties, fees, commissions, and other revenue. Number third, cash payments to suppliers for goods and services. Next, cash payments to and on behalf of employees. Next, cash receipts and cash payments of an insurance enterprise for premiums and claims, annuities, and other policy benefits. Cash payments or refunds of income taxes, unless they can be specifically identified with financing and investing activities. And the next one, cash receipts and payments relating to future contracts, forward contracts, option contracts, and swap contracts. And these are all nothing but reduction of risks to the extent through hedging. Hedging means reduction of risk. And these are used in foreign exchange, in the context of foreign exchange and risk management. So cash receipts and payments relating to futures contracts, forward contracts, option contracts, and swap contracts, when the contracts are held for dealing or trading purposes. So future contracts means the contract that you have to enter into in some future dates. Forward contracts means you have entered into a contract today and that will be executed after 1 or 2 months. Option contracts may be in the form of call option and put option, etc. Now, we are having some additional points. Some transactions, such as the sale of an item of plant, may give rise to a gain or loss, which is included in the determination of net profit or loss. However, the cash flows relating to such transaction are cash flows from investing activities. An enterprise may hold securities and loans for dealing or trading purposes in which case they are similar to inventory acquired specifically for resale. Therefore, cash flows arising from the purchase and sale of dealing or trading activities are classified as operating activities. Similarly, cash advances and loans made by financial enterprises are usually classified as operating activities since they relate to the main revenue producing activity of that enterprise. So, you have to keep this in your mind. Now, we are coming to investing activities. The activities of acquisition and disposal of long-term assets and other investments not included in cash equivalents are investing activities. So mind this, the activities of acquisition and disposal of long-term assets and other investments not included in cash equivalents are investing activities. Separate disclosure of cash flows arising from investing activities is important because the cash flows represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. So we proceed towards the examples of cash flows arising from investing activities. Cash payments to acquire fixed assets, including intangibles. These payments include those relating to capitalized research and development costs and self-constructed fixed assets. Then cash receipts from disposal of fixed assets, including intangibles. Cash payments to acquire shares, warrants, or debt instruments of other enterprises and interest in joint ventures, other than payments for those instruments considered to be cash equivalents and those held for dealing or trading purposes. Next, cash advances and loans made to third parties other than advances and loans made by a financial enterprise. Cash receipts from the repayment of advances and loans made to third parties other than advances and loans of a financial enterprise. Cash payments for future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. Then we are going to have cash received from future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes or receipts are classified as financing activities. Now, when a contract is accounted for as a hedge means reduction of an identifiable position, the cash flows of the contract are classified in the same manner as the cash flows of the position being hedged. Now, I am not giving emphasis on hedging. I am not giving emphasis on future contracts, forward contracts, option contracts, and swap contracts, because these you are going to learn so far your final examination is concerned. That is the paper Strategic Financial Management. Now, we are coming to financing activities. Financing activities are those activities which results in change in size and composition of owner's capital and borrowing of the organization. The separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims on future cash flows by providers of funds, both capital and borrowings, to the enterprise. Examples of cash flows arising from financing activities are cash proceeds from issuing shares or other similar instruments, cash proceeds from issuing debentures, loan notes, bonds, and other short or long-term borrowings. Next, cash repayments of amounts borrowed. Now, there are certain special treatment items in addition to the general classification of three types of cash flows. The applicable accounting standards provides for the treatment of the cash flows of certain special items, namely foreign currency cash flows. That is, cash flows arising from transactions in a foreign currency should be recorded in an enterprise's reporting currency. Say, if it is dollar, then in Indian currency it has to be translated. The reporting should be done by applying the exchange rate at the date of cash flow statement. A rate which approximates the actual rate may also be used. If the result is substantially the same as would arise if the rates at the dates of the cash flow were used. The effects of changes in exchange rates on cash and cash equivalents held in foreign currency should be reported as a separate part in the form of reconciliation in order to reconcile cash and cash equivalents at the beginning and end of the period. Now, unrealized gains and losses arising from changes in foreign exchange rates are not cash flows. To mind this, evidently, unrealized gains and losses arising from changes in foreign exchange rates are not cash flows. Now, extraordinary items. Any cash flows relating to extraordinary items should, as far as possible, to be classified them into operating, investing, or financing activities. And those items should be separately disclosed in the cash flow statement. Some of the examples for extraordinary items is bad debt recovered, claims from insurance companies, winning of a lawsuit, etc. The above disclosure is in addition to disclosure mentioned in Accounting Standard 5, that is net profit or loss for the period, prior period items, and changes in accounting policies. Then interest and dividends. Cash flows from interest and dividends received and paid should each be disclosed separately. The treatment of interest and dividends received and paid depends upon the nature of the enterprise, that is, financial enterprise and other enterprises. In case of financial enterprises, cash flows arising from interest paid and interest and dividend received should be classified as cash flows from operating activities. In case of other enterprises, cash flows arising from interest paid on term loans and debentures should be classified as cash flows from financing activities. Cash flows arising from interest paid on working capital loans should be classified as cash flow from operating activities. Interest and dividends received should be classified as cash inflow from investing activities. Dividends paid on equity and preference share capital should be classified as cash outflow from financing activities. Next, taxes on income. Cash flows arising from taxes on income should be separately disclosed. It should be classified as cash flows from operating activities unless they can be specifically identified with financing and investing activities. Investment in subsidiaries, associates, and joint ventures. When accounting for an investment in an associate or a subsidiary or a joint venture, an investor restricts its reporting in the cash flow statement to the cash flows between itself and the investment of the joint venture. For example, cash flow relating to dividends and advances. Then acquisition and disposal of subsidiaries and other business units. The aggregate cash flows arising from acquisition and from disposal of subsidiaries or other business units should be presented separately and classified as investing activities. An enterprise should disclose in aggregate in respect of both acquisition and disposal of subsidiaries or other business units during the period each of the following: the total purchase or disposal consideration, the portion of the purchase or disposal consideration discharged by means of cash and cash equivalents. Then we are coming to non-cash transactions. Investing and financial transactions that do not require the use of cash or cash equivalents should be excluded from a cash flow statement. Such transactions should be disclosed elsewhere in the financial statements in a way that provides all the relevant information about these investing and financing activities. The exclusion of non-cash transactions from the cash flow statement is consistent with the objective of a cash flow statement, as these do not involve cash flow in the current period. Examples of non-cash transactions: the acquisition of assets by assuming directly related liabilities, the acquisition of an enterprise by means of issue of shares, then conversion of debt into equity. Now we are coming to the procedural aspect, that is procedure to be followed in preparation of cash flow statement. The procedure used for the preparation of cash flow statement we may discuss as, that is, calculation of net increase or decrease in cash and cash equivalents accounts. The difference between cash and cash equivalents for the period may be computed by comparing these accounts given in the comparative balance sheets. I have already told you that cash flow, if you want to prepare, it has to be prepared from two balance sheets that will be given for two periods. The results will be cash receipts and payments during the period responsible for the increase or decrease in cash and cash equivalent items. Then calculation of the net cash provided or used by operating activities. It is accomplished by the analysis of profit and loss account, comparative balance sheet, and selected additional information. Next, calculation of the net cash provided or used by investing and financing activities. All other changes in the balance sheet items must be analyzed, taking into account the additional information and effect on cash may be grouped under the investing and financing activities. Final preparation of a cash flow statement. It may be prepared by classifying all cash inflows and outflows in terms of operating, investing, and financing activities. The net cash flow provided or used in each of these three activities may be highlighted. We have to ensure that the aggregate of net cash flows from operating, investing, and financing activities is equal to net increase or decrease in cash and cash equivalents. So this is a very important part. We have to ensure that the aggregate of net cash flows from operating, investing, and financing activities is equal to net increase or decrease in cash and cash equivalent. Now you have to report any significant investing, financing transaction that did not involve cash or cash equivalents in a separate schedule to the cash flow statement. Then reporting of cash flow from operating activities. The financial statements are generally prepared on accrual basis of accounting, under which the net income will not indicate the net cash provided by or net loss will not indicate the net cash used in operating activities. In order to calculate the net cash flows in operating activities, it is necessary to replace revenues and expenses with actual receipts and payments in cash. This is done by eliminating the non-cash revenues and non-cash expenses from the given earned revenues and incurred expenses. And now we are coming to the methods on the basis of which the cash flow statement can be prepared. There are two methods of converting net profit into net cash flows from operating activities. Number one, direct method and indirect method. Now, what is direct method? Under direct method, actual cash receipts for a period from operating revenues and actual cash payments for a period for operating expenses are arranged and presented in the cash flow statement. The difference between cash receipts and cash payments is the net cash flow from operating activities. It is, in effect, a cash basis of profit and loss account. Mind that it is, in effect, a cash basis profit and loss account. Now, we are coming to indirect method. In this method, the net profit or loss is used as the base, then adjusted for items that affected net profit but did not affect cash. Non-cash and non-operating charges in the profit and loss account are added back to the net profit, while non-cash and non-operating credits are deducted to calculate operating profit before working capital changes. It is a partial conversion of accrual basis profit to cash basis profit. Further necessary adjustments are made for increase or decrease in current assets and current liabilities to obtain net cash from operating activities. Then other disclosure requirements. An enterprise should disclose together with a commentary by management the amount of significant cash and cash equivalent balances held by the enterprise that are not available for use by it. There are various circumstances in which cash and cash equivalent balances held by an enterprise are not available for use by it. Examples include cash and cash equivalent balances held by a branch of the enterprise that operates in a country where exchange control or other legal restrictions apply, of which the balance is not available for use by the enterprise. Then additional information may be relevant to users in understanding the financial position and liquidity of an enterprise. Disclosure of this information together with a commentary by management is encouraged and may include the amount of undrawn borrowing facilities that may be available for future operating activities to settle capital commitments, indicating any restrictions on the use of these facilities, and number B, the aggregate amount of cash flows that represent increase in operating capacity separately from those cash flows that are required to maintain operating capacity. The separate disclosure of cash flows that represent increases in operating capacity and cash flows that are required to maintain operating capacity is useful in enabling the user to determine whether the enterprise is investing adequately in the maintenance of its operating capacity. An enterprise that does not invest adequately in the maintenance of its operating capacity may be future profitability for the sake of current liquidity and distribution to owners. Now, we are coming to format of cash flow statement as per AS3 revised and Indian AS7. Now, format of cash flow statement. AS3 revised and IND AS7 has not provided any specific format for the preparation of cash flow statements, but a general idea can be had from the illustration given in the appendix to the accounting standard. There seems to be flexibility in the presentation of cash flow statement. However, a widely accepted format under direct and indirect method is given. Option 1, cash flow statement, direct method. We have to have cash flow from operating activities. That is cash received from customers, cash paid to suppliers and employees. Then we'll be having cash generated from operations. Then income tax paid. Then cash flow before extraordinary items. Then proceeds from earthquake, disaster and settlement, etc. Then we are having net cash from operating activities. And we are considering it as A. Then cash flows from investing activities. That is net proceeds of the purchase of fixed assets, purchase of investment, interest received, dividend received. Then net cash from investing activities. Then cash flow from financing activities, proceeds from issue of share capital. Then net proceeds of the repayments from long-term borrowings, interest paid, dividend paid. Then we'll be having net cash from financing activities, that is number C. Then we'll be having net increase or decrease in cash or cash equivalents. So considering A plus B and C. Then we'll be having cash and cash equivalents at beginning of the period. Then we can have cash and cash equivalent at the end of the period. Now, so for the cash flow statement is concerned, you can check whether your answer is correct or not, looking into the balance sheet, that is current year balance sheet, because you'll be provided with the two balance sheets, previous period and current period. In the current period balance sheet, you will find cash and cash equivalents. It will be given. So if you get the same amount as cash and cash equivalent at the end of the period, then you can justify that the solution is correct. So that is all about your direct method. Now we are coming to option 2, that is cash flow statement, indirect method. So we'll be having cash flow from operating activities. Then we have to consider net profit before tax and extraordinary items. Then we have to make the adjustment for depreciation, exchange fluctuation, loss or gain, net, then loss on sale of fixed assets, interest income, dividend income, interest expense, dividend paid. Then we'll be having operating profit before working capital changes. Then we have to have adjustments for trade and other receivables, increase or decrease. Inventories, increase or decrease. Trade payable, increase or decrease. Then we'll be having cash generated from operations. Then we have to consider income tax. Then we will be having cash flow before extraordinary items. Then we will be having proceeds from earthquake, disaster settlement, etc. Then we will be having net cash from operating activities. That is A. Now we are going to have cash flow from investing activities. That is net proceeds or purchase of fixed assets. Then purchase of investment. Then interest received, dividend received. Then we'll be having net cash from investing activities, let it be B. Then cash flow from financing activities, that is proceeds from issue of share capital, net proceeds of the repayments from long-term borrowings, then dividend paid, interest paid. Then we'll be having net cash from financing activities, that is number C. Then we'll be having net increase or decrease in cash and cash equivalent, considering A, B, and C. Then we will be having cash and cash equivalents at the beginning of the year. Then we have cash and cash equivalents at the end of the year. Now, in theory, what we have to learn? You have to learn the various terms that are used in the context of cash flow statement, especially the cash and cash equivalents. And you have to remember how the cash flow statement is prepared under direct method and also under indirect method. Now we are coming to the first problem. The balance sheet of Sagar Limited are as follows. Balance sheet as on 31st December. Liabilities, assets. Then we are having equity share capital. Then we are having general reserve. Then we are having profit and loss account. We have debentures. We have Sunday creditors. We have bills payable. We have provision for tax and proposed dividend. Goodwill, land and building, plant and machinery, stock, debtors, bills receivable, prepaid expenses, cash in hand, and there is a loss, that is profit and loss account debit balance, that is 6,000. Okay, now we have to look into the additional information. During the year 2014, depreciation of rupees 8,000 and rupees 10,000 have been charged on land and building and plant and machinery respectively. An interim dividend of rupees 7,500 was paid during the year 2014. During the year 2014, machinery having a book value of rupees 8,000 was sold for rupees 7,000. We are required to prepare a cash flow statement by indirect method for the year ended 31st December 2014 as per Accounting Standard 3 and now it is Indian Accounting Standard, that is 7. So what we are required to do, we are required to calculate the cash flow statement of Sagar Limited for the year ended 31st December 2014. Now, for compiling the cash flow statement, we have to do some working notes. Okay. So first we are required to calculate net profit before tax. Now, if you look into the balance sheet, you will find that there was a loss in the first year as per the balance sheet. So we have to take profit and loss account at the beginning, 6,000. Then add profit for the period, that is profit after tax, Okay. Now we are having profit and loss account. In the second year, it is 29,000. Okay. Now I'll be coming one by one. You see, if you look into the balance sheet, you will find that there is a reserve. Okay. There is a reserve to the extent of 30,000. Then there is a profit and loss account, that is 29,000. Then provision for taxation, 25,000. And proposed dividend, 20,000. Now, what you are required to do, just consider this figure, that is profit and loss account at the beginning at profit for the period, 92,500. Okay, I'll come. Then let's transfer to reserves, 30,000. Then let's propose dividend. Then profit and loss at the end, 29,000. Net profit before tax is 1,17,500. Let's provision for tax 25,000. Then we get net profit after tax, that is 92,500. So that we have considered. Okay. Now we are coming to cash flow statement for the year ended 31st December. Now cash flows from operating activities, that is net profit before taxation and extraordinary items, that is 1,17,500. Then we are going to make the adjustment for depreciation on land and building, then depreciation on plant and machinery. Then there will be loss on sale of plant and machinery, because during the year 2014, machinery having a book value of rupees 8,000 was sold for rupees 7,000. So there is a loss to the extent of 1,000. So loss on sale of plant and machinery, 1,000. Then we'll be having goodwill. 2013 it was 55,000 and 2014 it is 45,000. So there is a decrease in goodwill. That means written off to the extent of 10,000. So goodwill written off, we have taken 10,000. Now after adding all these, we are having operating profit before working capital changes. That is 1,46,500. Then we have to look into increase or decrease in current assets and current liabilities. You see, there is an increase in stock, because in 2013 the stock was 42,000. 2014 the stock was 53,000. So difference is 11,000. So we are going to have increase in stock, that we have to deduct 11,000. Then debtors, there is an increase to the extent of 8,000 that we have to deduct. Then increase in bills receivable, 4,000, that again we have to deduct. Then decrease in prepaid expenses needs to be added. Then we are coming to liability side. There is a decrease in sundry creditors, that is outflow, 57,000 minus 46,000, that is 11,000. Then there is a decrease in bills payable to the extent of 24,000, that is deducted. So after all these plus minus, we get net cash from operating activities. Then we are having cash flows from investing activities, as it is given in the problem that during the year 2014, machinery having a book value of rupees 8,000 was sold for rupees 7,000. So this 7,000 is an inflow. So sale of plant and machinery is 7,000 we have added. Then we are going to have, that is land and building. You see, 80,000 was the opening balance and closing balance is 90,000. Okay. There is a depreciation to the extent of 8,000. Okay. So if we put the opening balance of land and building as two balance BD, and if we write by balance CD 90,000, and if we write by depreciation 8,000, then we'll be having, that is, purchase of land and building will be 18,000. Similarly, by preparing the plant and machinery account, we are having opening balance, two balance BD 40,000, by balance CD 1 lakh, by depreciation 10,000, then by bank sale, okay, and there is a loss to the extent of 1,000. By accounting for all these, we get purchase of plant and machinery to the extent of 78,000. So we have considered the total, okay. Then we are having cash flows from financing activities. Look into the balance sheet. There is a debenture to the extent of 1 lakh. That was in the year 2013, 1 lakh. Now, in 2014, there is no debentures. So during the year or over the year, there is a redemption of debenture, payment made to the debenture holders. So redemption of debentures, that is 1 lakh, that is an outflow. Then looking into the equity share capital, in the first year, the equity share capital was 1 lakh 50. But in the second year, it becomes 2 lakh 50. So there is an increase in shares, that is issue of shares to the extent of 1 lakh. That is a source. There is an inflow rather. So issue of share capital. Then there is a payment of interim dividend, 7,500. That is an outflow. So plus minus after that we get minus 7,500. So after taking into consideration the figures, we get, that is net decrease in cash and cash equivalents, that is 6,000. Now cash and cash equivalents at the beginning of the year It is given 10,000. Okay. Then what we get? We get net decrease in cash and cash equivalents, that is 6,000. Then cash and cash equivalents at the beginning of the year, 10,000. So cash and cash equivalents at the end of the year is 4,000. That is the figure which is given in the balance sheet for the second year, so that we can say that the solution is correct. Okay. Now we are coming to our next problem. Just have a good look. The balance sheet of JK Limited as on 31st March for 2 years are given below. All figures in rupees 1,000. Liabilities year 1, year 2. Assets year 1, year 2. We are having share capital, then capital reserve, then general reserve, then PL account, then 9% debentures, current liabilities, proposed dividend, provision for tax, and unpaid dividend. In the asset side, we are having fixed assets, less depreciation. So after deducting this, we get net block. Then we are having investments, then cash, then other current assets, including stock and preliminary expenses. So we are required to prepare a cash flow statement from the balance sheets that are given and considering the additional information. The first information is, during the year, certain fixed assets with a book value of rupees 2,40,000, accumulated depreciation rupees 84,000 was sold for rupees 1,20,000. So fixed assets book value 2,40,000, accumulated depreciation, that is summation of depreciation till date, that is accumulated depreciation rupees 84,000, and that was sold for rupees 1,20,000. Next, provided rupees 4,20,000 as depreciation. Some investment are sold at a profit of rupees 48,000, and profit was credited to capital reserve. It decided that stock should be valued at cost, whereas previously the practice was to value stock at cost less 10%. The stock was rupees 2,59,200 as on 31st March of year 1. The stocks as on 31st March of year 2 was correctly valued at rupees 3,60,000. Then decided to write off fixed assets costing rupees 60,000, on which depreciation of rupees 48,000 has been provided. And the last information is, debentures are redeemed at rupees 105, that is at 5% premium. Now, it is given in the question, prepare a cash flow statement from the above and the following additional information. Now, what I am going to tell you right now, that if nothing has been mentioned about the method of preparation of the cash flow statement, then it is wise to apply the concept of indirect method. Okay, and looking into the information and the balance sheet, you can easily understand whether there is a cash purchase, cash sales, collection from debtors, etc. These are not mentioned. Hence, we are not in a position to compile the cash flow statement under direct method. Hence, we have to follow the indirect method. Now, we'll be preparing the necessary accounts, that is investment account, fixed asset account, accumulated depreciation account, assets disposal account, fixed asset return of account, and again we are going to compute net profit before taxation. Okay, and then we have to make a note, that is computation of increase or decrease in other current assets. Then we have to prepare cash flow statement for the year end date 31st March of year 2. So it is not so easy, but you have to understand each and every item minutely to understand the question and also to solve. So please give me 2 minutes time, and by this time you just look into investment account. Okay, and from the investment account, that is a non-current asset account, and from all the non-current assets account, we have to see how much there is inflow and how much there is outflow of cash. And accordingly, we are going to group under the operating, financing, and investing activities. Okay. So please look into the investment account. Please allow me 2 minutes. Now look into investments account. You see opening balance, we have bought forwarded as it is given, that is 4,80,000. Closing balance is also available from the second year balance sheet. We have written buy balance carried down, that is 3,84,000. Now you see there is a capital reserve to the extent of 48,000 in the year 2. Okay. And you see information number C, some investment are sold at a profit of rupees 48,000 and profit was credited to capital reserve. So that's why we have written two capital reserve, profit on sale of investments 48,000. Okay. And after jotting down the respective figures in the debit and credit side, in the credit side we'll be having, that is buy bank sale value of investment, that we'll get as a balancing figure. Okay. So sale of investment, that is 1,44,000. Now we are coming to fixed assets account. Now remember, when fixed assets are given like this, that is gross block. Fixed asset gross block means fixed asset at cost. And over the year, there is an increase. Less accumulated depreciation, then we are having debt block. So we are required to open the fixed assets account in gross block concept. So two balance BD 38 lakhs 40,000 it is given 3840,000 and closing it is given 4560,000. That is, we are writing buy balance CD given 45 lakh 60,000. Now you see, it is given during the year certain fixed assets with a book value of rupees 2,40,000. Accumulated depreciation 84,000 was sold for rupees 1,20,000. So we are going to transfer to the assets disposal account to the extent of rupees 2,40,000 directly. Okay. Then you see, decided to write off fixed assets costing rupees 60,000. Hence, we are going to write buy fixed assets written off account 60,000. So, after considering fixed assets account at gross figure, we get credit minus debit. Credit is more than the debit, so that we can have two bank account balancing figure asset purchased. So that is our objective, to justify whether there is an inflow or outflow of cash. Next, we are going to have accumulated depreciation. So accumulated depreciation, it is deducted from the asset side, means indirectly it is shown in the liability side. So we are having buy balance BD given 11 lakh 4,000. Just have a good look. 11 lakh 4,000. And 1,392,000, that is the closing balance. So in accumulated depreciation, we are having two balance CD given 13 lakhs 92,000. Okay. Again, I am showing you that is 13 lakhs 92,000. Now, so far asset disposal account is concerned, that is, just have a look, accumulated depreciation 84,000. So to the extent of assets sold, it will be transferred to the asset disposal account on assets sold, that is 84,000. Then fixed assets written off, on which 48,000 depreciation has been provided, that is also to be adjusted. That is two fixed assets written off on assets written off 48,000. Okay. Now, after taking into consideration all these figures, it is given provided 4,20,000 as depreciation. So we are going to write buy profit and loss account depreciation for the year, that is 4,20,000. So both the sides of the accumulated depreciation is tallied. Now we are going to have assets disposal account. So in the assets disposal account, we are going to write two fixed assets account, cost of assets 2,40,000. Then buy bank account sale of assets 1,20,000. Buy accumulated depreciation 84,000. Then buy profit and loss account, loss on sale of fixed assets 36,000. Okay. Then we are having fixed assets written off. That is buy accumulated depreciation, double entry 48,000. Two fixed assets account, cost of assets written off 60,000. Buy profit and loss on write-off of fixed assets 12,000. Now we are going to have calculation of net profit before taxation. Profit made during the year, there is increase in profit and loss account balance. That is 3 lakh 60 minus 2 lakh 88. That is 72,000. Then add back provision for taxation for the year, 4 lakh 8,000. Provision for dividends is 1 lakh 74,000. Transfer during the year, 9 lakh 60 minus 8 lakh 16. That is 1 lakh 44,000. Then revaluation of opening stock will increase stock and reduce profits. That is 2,59,200 into 10 by 90. It comes to 28,800. Then net profit before taxation taken to cash flow statement, that is 7,69,200. And I have shown you corrected value of opening stock will be 2,59,200 divided by 90%. It comes to 2,88,000. Now we are going to calculate increase or decrease in other current assets. So we are having particulars, then 31st March of year 1, then 31st March of year 2. Other current assets as per balance sheet, 11,34,000 and 12,72,000, that is given. Less stock included in the above, 2,59,200 and 3,60,000. Hence, the current assets excluding stock is 8,74,800 and 9,12,000. Other current assets are taken as per balance sheet, which includes the unrecorded amount of stock as on 31st March of year 1. Hence, the unrecorded stock amount is reduced therefrom to determine the other current assets. Now, we are going to have the cash flow statement for the year ended 31st March of year 2. Cash flow from operating activities. Profit before taxation after adjustment of stock that we have calculated under working note number 6, that is 7,69,200. 7,69,200. Then adjustment for preliminary expenses. You look into the question. Preliminary expenses were at the beginning of the year 96,000. At the end of year 2, there is 48,000. So during the year, 48,000 has been written off as preliminary expenses. So we are going to consider this in the cash flow statement. There is adjustment for preliminary expenses written off 96,000 minus 48,000, that is 48,000. Depreciation as per working note 3, 4,80,000. Then loss of fixed assets, working note 4, 36,000. Then decrease in value of fixed assets written off, that is working note 5, that is 12,000. Premium on redemption of debentures, 14,400. Then operating profit before working capital changes is 12,99,600. Then adjustment for increase in current liabilities, that is indirectly it is an inflow. Then increase in stocks, that is 72,000, that is an outflow. Increase in other current assets as per working note 7, 37,200 outflow. Then cash generated from operations is 12,38,000. Less income tax paid 4,32,000. Then net cash flow from or used in operating activities. So net cash flow, that is 8,06,000. Then cash flow from investing activities, there is purchase of fixed assets, working note 2, that is outflow 10,20,000. Proceeds from sale of fixed assets, working note 4, that is 1,20,000. Proceeds from sale of investment, working note 1, that is 1,44,000. Then net cash flow from or used in investing activities, that is 7,56,000. Then we are having cash flow from financing activities, that is proceeds from issuance of share capital, that is 4,80,000 inflow. Redemption of debentures at 5% premium, that is 3,02,400. dividend paid 1,04,000. Then net cash flow or used in financing activities, that is net cash flow is 51,600. So after doing A plus B plus C, we get net increase in cash and cash equivalents, 1,02,000. Cash and cash equivalents at the beginning of the year given 2,10,000. And finally, we are having cash and cash equivalents at the end of the year given, that is 3,12,000. Just we are looking into the balance sheet to see that, that is, you see 312,000. That is, we get the answer, that is uh, 3,12,000. So solution is correct. Now we are going to have this problem. Prepare a cash flow statement as per AS3 revised and Indian Accounting Standard 7 from the following information, direct and indirect method. So we are provided with the 2 years balance sheet, first year, second year. We are having share capital. We are having reserves and surplus, 12% debentures, sundry creditors, outstanding rent, income tax payable. Then we are having plant and machinery, land and building, investment, inventories, sundry debtors, prepaid selling expenses, cash at bank, and cash in hand. Now we are also provided with the second year profit and loss account. That is 2 opening stock, 2 purchases, 2 wages, 2 gross profit. Then buy sales, buy closing stock. Then gross profit bought forwarded, 2 depreciation, 2 office expenses, 2 rent, 2 selling and distribution expenses, 2 income tax. Then after jotting down gross profit, discount received, commission received and dividend received, we get the net profit. Then after net profit, that is brought forwarded, bought forwarded, that was at the beginning, that is 1,690, then by net profit 1,560, 2 dividend, then it is 2 balance carried down. Okay, so you are provided with 2 years balance sheet and profit and loss account for the second year ending. And from these, we are going to have the cash flow statement, that is indirect method. Okay, I'm just showing it as indirect method. That is cash flow from operating activities, net profit after taxation. We are adding back provision for taxation, then depreciation, then dividend income taken in investing activities. Then we have operating profit before working capital changes. Now we are required to consider one by one whether there is an increase or decrease in current assets and current liabilities. So there is an increase in stock. So it is an outflow. Increase in debtors, it is an outflow. Interest in prepaid selling expenses, that is an outflow. Increase in creditors, that is inflow. Increase in outstanding rent, that is inflow. Then we have cash generated from operations. Less income tax paid, opening balance plus provision minus closing balance, we get 1,365. Then we have net cash flow from operating activities, 936. Then cash flow from investing activities, we get purchase of plant and machinery. That is closing balance plus depreciation minus opening balance, we get 1,937. Dividend income received 250. So net cash flow or used in investing activity, that is used 1,677. Then we are having cash flow from financing activities, proceed from issue of equity shares, then proceed from issue of 12% debentures, then dividend paid as per PL, then net cash flow or used in financing activity, that is cash flow 1950. So net increase in cash and cash equivalents, taking into consideration A plus B plus C, that is 1209. Then cash and cash equivalents at the beginning of the year, then cash and cash equivalents at the end of the year, we get 1729. That is 1677 plus 52. That is provided in the problem. That is 1677 plus 52. So that we can say that our answer is correct. Now we are coming to our last problem. Then we'll go to leverage. Balance sheet of a company as on first year and second year were as follows. Equity share capital, then 8% preference share capital, general reserve, securities premium, profit and loss account, credit balance, 11% debentures, creditors, provision for tax, proposed dividend. Then we are having goodwill, land and building, plant and machinery, investment, non-trading, stock, debtors, cash and bank, prepaid expenses, premium on redemption of debentures. So we go to the additional information. If you look into the additional information, the first information is given. Investment were sold during the year at a profit of rupees 15,000. During the year, an old machine costing rupees 80,000 was sold for rupees 36,000. Its WDV was 45,000. Depreciation charged on plant and machinery at 20% on the opening balance. And it is clearly given there was no purchase or sale of land and building. Provision for tax made during the year was 96,000. Preference shares were issued for consideration of cash during the year. From the above prepared, cash flow statement as per AS3 and as per Indian Accounting Standard 7 and extra that you have to prepare, that is schedule of changes in working capital. Okay, so in order to compile the cash flow statement, we have to take non-current assets and open the accounts to justify what is the inflow or outflow. So we open plant and machinery, we take opening balance, we take closing balance, we take buy bank sale, we take buy profit and loss, loss on sale of assets, buy depreciation, 20% on opening balance, that is 1,20,000. So credit minus debit is the bank, that is two bank account, balancing figure, asset purchase. Now we go to investment account. In investment account, we write two balance BD, then buy balance CD. Profit on sale of investment is given 15,000. Then debit minus credit, we get buy bank, balancing figure, investment sold. Now we are having cash flow statement for the year ended 31st March, year 2. That is cash flow from operating activities. Profit made during the year, we take the difference of PL account, that is 3 lakh minus 2 lakh 10, that is 90,000. Then add provision for taxation for the year 96,000. Proposed dividend for the year 2, that is 1 lakh 44. Transferred to reserve during the year, that is second year balance minus first year balance, that is 25,000. So after adjusting all these, we get net profit before taxation. Then we are adding back goodwill written off 1 lakh minus 80,000, that is 20,000. Depreciation on plant and machinery 1 lakh 20,000. Depreciation on building, that is 7 lakh minus 6 lakhs 50, that is 50,000. Loss on sale of machinery 9,000. Then profit on sale of investment, 15,000. Then we get operating profit before working capital changes. Then we are going to make plus minus, that is adjustment for changes in current assets and current liabilities. Decrease in stock, that is 4 lakh minus 3 lakh 85, that is inflow. Decrease in prepaid expenses, inflow 4,000. Increase in creditors, 2 lakh 15,000 minus 1 lakh 85,000, that is 30,000, that is inflow. Increase in debtors, 4 lakh 15,000 minus 2 lakh 88,000, that is outflow, 1 lakh 27,000. So after adjusting all these, we get cash generated from operation, 4 lakh 61,000. Less income tax paid, that is 71,000. We have taken 80,000 plus 96,000 minus 1 lakh 5,000. Just have a look. Provision for tax 80,000, opening, closing. Then provision for tax made during the year 96,000. So after adjusting all these, 80 plus 90 minus 1 lakh 5, so income tax paid is 71,000. You can prepare one account where you can write provision for taxation by balance BD, to balance CD, okay, to bank by PL account. So we get net cash flow, that is net cash flow from operating activities, 3 lakh 90. Then we are having cash flow from investing activities. Purchase of plant and machinery, we have already got from working note 2, 2 lakh 25. Proceeds from sale of machinery, 36,000. Proceeds from sale of investment, working note 3, 35,000. Then net cash used in investing activities, 1 lakh 54,000. Then we are having cash flow from financing activities. Issue of preference shares at premium, 1 lakh plus 25,000, that is 1 lakh 25. Redemption of debentures at premium, 2 lakh plus 20,000, that is 2 lakh 20. Dividend paid for the last year is to be paid in this year, 1 lakh 36,000. Then net cash used in financing activities, 2 lakh 31. So net increase or decrease, there is an increase in cash and cash equivalents, 5,000. Cash and cash equivalents at the beginning of the year, 88,000. So finally, we can arrive at the cash and cash equivalent at the end of the year, that is 93,000. That is given in the question. Just look, 93,000. So we may say that our answer is correct. Now, apart from the cash flow statement, you are also required to prepare statement of change in working capital that we have already done in fund flow. So we are required to jot down current assets, and then we are required to jot down current liabilities. Then we calculate current assets minus current liabilities, net working capital, and it can be seen that there is an increase in working capital. Okay, so with this, I close this cash flow, and we are coming to just a minute. The chapter leverage. Okay. Now we are coming to the concept of leverage. That is also a very important topic. Now, financial decision is one of the integral and important parts of financial management in any kind of business concern. A sound financial decision must consider the broad coverage of the financial mix, that is capital structure, and total amount of capital, that is called capitalization, and overall cost of capital that is represented by K suffix O. Capital structure is one of the significant things for the management since it influences the debt equity mix of the business concern, which affects the shareholders' return and risk. Hence, deciding the debt equity mix plays a major role in the part of the value of the company and market value of the shares. Now, the debt equity mix of the company can be examined with the help of leverage. Now, we have to know what is the meaning of leverage. The term leverage refers to an increased means of accomplishing some purpose. Leverage is used to lifting heavy objects, which may not be otherwise possible. In the financial point of view, leverage refers to furnish the ability to use fixed cost assets or funds to increase the return to its shareholders. And accordingly, we are having different types of leverage. Leverage can be classified into three major headings according to the nature of the finance mix of the company. So we are having leverage, that is financial leverage and operating leverage, and ultimately we are having combined leverage. The company may use finance or leverage or operating leverage to increase the EBIT and EPS. EBIT means earning before interest and tax. EPS means earning per share. Now, what is operating leverage? The leverage associated with investment activities is called as operating leverage. It is caused due to fixed operating expenses in the company. Operating leverage may be defined as the company's ability to use fixed operating costs to magnify the effects of changes in sales on its earnings before interest and taxes. Operating leverage consists of two important costs, that is, fixed cost and variable cost. When the company is said to have a high degree of operating leverage, if it employs a great amount of fixed cost and smaller amount of variable cost. Thus, the degree of operating leverage depends upon the amount of various cost structure. Operating leverage can be determined with the help of a break-even analysis also. Operating leverage can be calculated with the help of the following formula. OL is equal to C stands for contribution divided by OP. OP stands for operating profit or EBIT, earning before interest and tax. So OL is equal to operating leverage, C is equal to contribution, OP is equal to operating profits. Now we are having the concept called degree of operating leverage. The degree of operating leverage may be defined as percentage change in the profits resulting from a percentage change in the sales. It can be calculated with the help of the formula degree of operating leverage, percentage change in profits divided by percentage change in sales. Now we are discussing about uses of operating leverage. Operating leverage is one of the techniques to measure the impact of changes in sales, which lead for change in the profits of the company. If any change in the sales, it will lead to corresponding change in profit. Operating leverage helps to identify the position of fixed cost and variable cost. Operating leverage measures the relationship between sales and revenue of the company during a particular period. Operating leverage helps to understand the level of fixed cost which is invested in the operating expenses of business activities. Operating leverage describes the overall position of the fixed operating cost. Now, we are coming to a problem. From the following selected operating data, determine the degree of operating leverage. Which company has the greater amount of business risk and why? So we are having sales of both the companies A, B. We are having fixed cost. Variable expenses as a percentage of sales is 50% for company A and 25% for company B. So we are calculating statement of profit. We have taken sales, then we deducted variable cost, we get contribution. From contribution, if we deduct the fixed operating cost, we get operating profit. So operating leverage, contribution by operating profit for company A, leverage is 12,50,000 divided by 5 lakhs, that is 2.5, and B company leverage, that is operating leverage, it is 22 lakhs 25,000 divided by 7 lakhs, that is 3. Operating leverage for company B, for B company is higher than that of A company. B company has a higher degree of operating risk. The tendency of operating profit may vary proportionately to its sales, is higher for B company as compared to A company. Now we are coming to financial leverage. Leverage activities with financing activities is called financial leverage. Financial leverage represents the relationship between the company's earnings before interest and taxes, EBIT, or operating profit, and the earning available to equity shareholders. Financial leverage is defined as the ability of a firm to use fixed financial charges to magnify the effects of changes in EBIT on the earnings per share. It involves the use of funds obtained at a fixed cost in the hope of increasing the return to the shareholders. The use of long-term fixed interest-bearing debt and preferential capital along with share capital is called financial leverage or trading on equity. Financial leverage may be favorable or unfavorable, depends upon the use of fixed cost funds. Favorable financial leverage occurs when the company earns more on the assets purchased with the funds than the fixed cost of their use. Hence, it is called a positive financial leverage. Unfavorable financial leverage occurs when the company does not earn as much as the funds cost. Hence, it is called as negative leverage. Financial leverage can be calculated with the help of the formula, that is, financial leverage is EBIT divided by EBT or PBT. FL is financial leverage, OP is operating profit, that is EBIT, and profit before tax or EBT, that is earning before tax, or PBT, same, that is profit before tax. Now we are coming to degree of financial leverage. Degree of financial leverage may be defined as the percentage change in taxable profits as a result of percentage change in earning before interest and tax, that is EBIT. This can be calculated with the help of the formula DFL is equal to percentage change in taxable income divided by percentage change in EBIT. Alternative definition of financial leverage, there is an author called Gitmar. Financial leverage is the ability of a firm to use fixed financial changes to magnify the effects of change in EBIT and EPS. And accordingly, financial leverage is EBIT by EPS, where FL is equal to financial leverage, EBIT is equal to earning before interest and tax, EPS is equal to earning per share. Now we are going to discuss financial leverage, uses of financial leverage. Financial leverage helps to examine the relationship between EBIT and EPS. Financial leverage measures the percentage of change in taxable income to the percentage change in EBIT. Financial leverage locates the correct profitable financial decision regarding capital structure of the company. Financial leverage is one of the most important devices which is used to measure the fixed cost proportion with the total capital of the company. If the firm acquires fixed cost funds at a higher cost, then the earnings from those assets, the earning per share return on equity capital will decrease. Now we are taking one question. A company has the following capital structure: equity share capital 10% preference share capital and 8% debentures. The present EBIT is rupees 50,000. Calculate the financial leverage assuring that the company is in 50% tax bracket. So earning before interest and tax or operating profit, then we deduct interest on debentures, then we get earning before tax, EBIT, less income tax, we get profit. Then financial leverage, operating profit divided by profit before tax, that is 1.25. Now, we are coming to our next problem. XYZ Limited decides to use two financial plans and they need rupees 50,000 for total investment. Debenture interest at 10%, 40,000 and 10,000. Equity share of rupees 10 each, 10,000 and 40,000. Total investment needed 50,000, 50,000. Number of equity shares 4,000 and 1,000. The earnings before interest and tax are assumed 5,000 and 12,500. The tax rate is 50%. Calculate the EPS. So, EPS where EBIT is 5,000, we take EBIT, then deduct interest on debt, then we get earnings before tax, that is EBT, less tax at 50%, then earnings available to equity shareholders we get. Number of equity shares given earning per share, that is earning available to equity shareholders divided by number of equity shares, it comes to 50 paise and 50 paise in the both cases. Now, we are having, when EBIT is 12,500, earnings before interest and tax is 12,500, 12,500. Less interest on debt, after deducting we get earnings before tax, that is EBT, less tax at 50%. So we get earnings available to equity shareholders. Then number of equity shares, we get earning per share. That is divided by earnings available to equity shareholders divided by number of equity shares, we get earning per share. Now, there is a distinction between operating leverage and financial leverage. That is, operating leverage is associated with investment activities of the company. Financial leverage is associated with financing activities of the company. Operating leverage consists of fixed operating expenses of the company, whereas financial leverage consists of operating profit of the company. Operating leverage, it represents the ability to use fixed operating cost, and financial leverage, it represents the relationship between EBIT and EPS. Operating leverage can be calculated by the formula contribution by operating profit, whereas financial leverage is operating profit divided by PBT. A percentage change in the profits resulting from a percentage change in the sales is called as a degree of operating leverage. A percentage change in taxable profit is the result of a percentage change in EBIT in financial leverage. Trading on equity is not possible while the company is having operating leverage. Trading on equity is possible only when the company uses financial leverage. Operating leverage depends upon fixed cost and variable cost, whereas financial leverage depends upon the operating profits. Tax rate and interest rate will not affect the operating leverage. Financial leverage will change due to tax rate and interest rate. Now, we are having financial break-even point. It is the level of EBIT which covers all fixed financing costs of the company. It is the level of EBIT at which EPS is 0. Then we are having indifference point. It is the point at which different sets of debt ratios, percentage of debt to total capital employed in the company, give the same EPS. Now we are having combined leverage. When the company uses both financial and operating leverage to magnification of any change in sales into a larger relative changes in earning per share, combined leverage is also called as composite leverage or total leverage. Combined leverage expresses the relationship between the revenue in the account of sales and the taxable income. Combined leverage can be calculated with the help of the following formula. That is, CL means combined leverage is equal to OL into FL, and whereby CL is equal to contribution by operating profit, and financial leverage is operating profit divided by PBT. Operating profit cancels out. We have C divided by PBT, where CL is equal to combined leverage, OL is equal to operating leverage, FL is equal to financial leverage, C is equal to contribution, OP is equal to operating profit, that is EBIT, and profit before tax is PBT. Then we are going to have degree of combined leverage. The percentage change in a firm's earning per share, EPS, results from 1% change in sales. This is also equal to the firm's degree of operating leverage, DOL, times the degree of financial leverage at a particular level of sales. So degree of combined leverage is percentage change in EPS divided by percentage change in sales. So we can take a problem. Kumar Company has sales of rupees 25 lakhs, variable cost 12 lakh 50, and fixed cost rupees 50,000, and debt rupees 12 lakh 50,000 at 8% rate of interest. Calculate combined leverage. So we are having sales, deducting variable cost, we get contribution. From contribution, we deduct the fixed cost, so we'll have operating profit. So combined leverage is equal to operating leverage into financial leverage. So operating leverage contribution by operating profit, that is 10 lakhs divided by 5 lakhs, that is 2. And financial leverage, earnings before interest and tax, EBIT is 5 lakhs, less interest on debenture, 8% of 12 lakh 50, it comes to 1 lakh. So earnings before tax is 4 lakh. So we are having financial leverage operating profit divided by earnings before tax, that is 5 lakhs by 4 lakh, that is 1.25. So combined leverage we get 2 into 1.25, that is 2.5. Then a firm's details are as under. Sales, variable cost, fixed cost. It has borrowed 10% per annum and its equity share capital is 10 lakhs, rupees 100 each. Calculate operating leverage, financial leverage and combined leverage, and return on investment. If the sales increase by 6 lakhs, what will be the new EBIT? So we get sales, then variable cost we have deducted, then contribution, then fixed cost we get EBIT, less interest EBT, less tax 50%, we get earnings after tax, then number of equity shares, then we get EPS, then sales 24 lakhs, less variable cost, contribution, less fixed cost, we get EBIT, less interest, then we get EBT, less tax 50%, we get EAT, then number of equity shares 10,000, we get EPS 5. So operating leverage is nothing but 12 lakh by 2 lakhs, that is 6. Financial leverage 2 lakhs by 1 lakh. Combined leverage 6 into 2, that is 12. Return on investment 50,000 divided by 10 lakhs into 100, that is 5%. Here return on investment is calculated as ROE, that is earning after tax minus preference dividend divided by equity shareholders fund. Now operating leverage is 6. 6 is equal to delta EBIT, means change in EBIT divided by 0.25. So change in EBIT will be 1.5, increase in EBIT, that is 2 lakhs into 1.5, that is 3 lakhs. New EBIT is 5 lakhs. Now we can have a question like, calculate the operating leverage for each of the 4 firms A, B, C, D from the following price and cost data. Sale price per unit is given, variable cost per unit is given, fixed operating cost is given. What calculations or conclusions you can draw with respect to levels of fixed cost and the degree of operating leverage result? Explain. Assume number of units sold is 5,000. So State-wise, we are going to compute sales units, then sales revenue in units, units into selling price, less variable cost, units into variable cost per unit, less fixed operating cost, we get EBIT. So there are four A, B, C, D. So degree of operating leverage, it is current sales minus variable cost by current EBIT. So we are having degree of operating leverage for farm A, 1 lakh minus 30,000 divided by 10,000, that is 7. Degree of operating leverage B, that is 1 lakh 60 minus 80,000 divided by 40,000, 2. Degree of operating leverage for farm C, 2 lakh 50 minus 1 lakh, that is 50,000, is equal to 3. Degree of operating leverage from farm D, 3 lakh 50 minus 2 lakh 50 by 1 lakh, that is 1. The operating leverage exists only when there are fixed costs. In case of farm D, there is no magnified effect on the EBIT due to change in sales. A 20% increase in sales has resulted in a 20% increase in EBIT. In the case of other farms, operating leverage exists. It is maximum in farm A, followed by farm C and minimum in B. The interception of dual of 7 is that 1% change in sales result in 7% change in EBIT level in the direction of the change of sales level of farming. Now, we can have a question like this. Calculate the operating leverage, financial leverage, and combined leverage from the following data under situation 1 and 2. We have installed capacity, then actual production sales, 75% of the capacity is selling price variable cost. Fixed cost under situation 1 given 15,000, under situation 2 it is given 20,000. Then we are having financial plans A and B, equity 10,000 and 15,000, debt rate of interest at 20%, 10,000 and 5,000. So total is 20,000 and 20,000. So operating leverage situation 1 and situation 2, we can easily calculate, taking into consideration sales less variable cost, contribution less fixed cost, EBIT, then operating leverage we get contribution divided by EBIT. Financial leverage we have to calculate separately for two situations having different dates. EBIT we take 30,000, 30,000, less interest on debt is 2,000, 1,000, EBT 28,000 and 29,000. So financial leverage will be EBIT by EBT. It is 1.07 and 1.034. Situation 2, we are having different debt and different interest. EBIT 25,000, 25,000. Interest on debt is same, but EBIT is different. That is 2,000 and 1,000. So we have EBT 23,000 and 24,000. So financial leverage FL EBIT by EBT 1.09 and 1.04. So situation 1 combined leverage we get financial leverage into operating leverage, that is 1.55, and situation 2 combined leverage we get financial leverage into operating leverage, that is 1.872. That is all about for your leverage. Now, we are about to close today. Now, remember, while preparing the cash flow statement, until and unless it is specified, please prepare the cash flow statement on indirect method. If it is precisely given to prepare the cash flow statement on direct method, then you have to follow that. Now, in cash flow statement, the important considerations are dividing the activities into operating, investing, and financing activities. And remember, The results of cash flow, whether it is correct or not, that you can check from your end result of the cash flow statement and comparing the latest year balance sheet where the amount of cash and cash equivalents will be given. Now, in the context of leverage, what we have learned, what we have learned, that we have learned that there are three types of leverages: operating leverage, financial leverage, and combined leverage. So, combined leverage is nothing but it is a multiplication of operating and financial leverage. So, operating leverage will occur when there is fixed operating cost is present in the cost structure. And the financial leverage will result when in the capital structure, when the company has undertaken debt burden, and from that debt burden, company has to pay the interest. So operating leverage is nothing but contribution divided by EBIT, whereas financial leverage is EBIT divided by EBT, and the combined leverage is multiplication of these two. With this, I finish the class. Hope you have understood. Thank you for attending the class. Thank you very much.
Thank you.
Thank you.